we do recognize that there's a number of questions in the Q&A. If there's time at the end, we'll go back to these. And again, if we haven't got to them, we will endeavor to get back to you. But after tax, we now talk about valuation and how that plays a key role in ultimately what tax you pay, but how does a valuation work? And I'm pleased to have our second speaker, a gold medal winner in the CBV exam, Janece Boersma. Janece, you want to take it away, please?
Yeah, thanks, Ron. So as Ron mentioned, I'm going to be covering the topic of how to value your business. So that's probably one of the first questions you have when you think about selling your business, as the value of your business is going to drive the selling price. And also there's some steps you can take prior to selling your business to hopefully maximize the value of your business and get the most out of your business, selling your business. So today I'm covering two main topics, the building blocks of value and valuation approaches. So on the next slide, we will start with the building blocks of value. So first, we're going to start with a bit of a picture of a house. So we break down the house into three main components. Start with the foundation, then we have physical structure, so the walls, the doors, the roof, and then we have extras like the furniture, the pictures on the wall, and maybe a hot tub. So on the next slide, we'll tie this into valuation concepts. And so here we have what we refer to as the three building blocks of value: net tangible assets, goodwill, and redundant assets. So starting with net tangible assets, these are the foundation of your company and its value. So net tangible assets are the assets and liabilities that are required to run your business, fund the day-to-day operations, and really actually generate money from your company, the assets that are required. So when we're thinking about this, we think about cash in the bank, accounts receivable, payable, inventory, and any property, plant, and equipment that are also required in your business. Then we move on to the middle building block, which is goodwill. And so this we compare to the physical structure of the house. So goodwill, unlike walls and a roof, can't be seen really through tangible measures. That goodwill represents the intangible value of your business. So really the value of your business that's beyond your equipment and your inventory and the cash in your bank. Goodwill is derived from a variety of different factors of your business. It could be relating to the business's reputation or brand value, relationship with customers, a lot of different intangible measures. So when we look at net tangible assets and goodwill together, we get the total the business value, or in the valuation world, what's referred to as enterprise value. And then our third building block there on the top is the redundant assets. And these are the hot tubs of your business, assets and liabilities that may be owned by the company, but are not required in the day-to-day operations of your company. So an example of this is Joe's plumbing business. Joe had a great year last year and had some extra cash, so he decided to invest in Apple shares. Now, these shares aren't required at all for Joe to keep operating his plumbing business, but they still have value and are owned by the company, so the value is there. Joe could remove the shares from the business and still keep operating. So the three building blocks here all together make up the total fair market value of the legal entity, also referred to as share value or equity value. However, when you're selling the business, typically redundant assets are removed prior to sale, and you would transact on the business or enterprise value. Similar to if you think about your house, typically when you sell your house, you take all your furniture with you and just sell the foundation and the structure. So similar to that.
So Denise, sorry to interrupt for a second. I think there's a link between what you're talking about and redundant assets. It could be cash, the housing example is hot tubs, but cash or Apple shares. Is that the same thing that Cody's talking about that you can't have in order to get the capital gain exemption?
Yeah. So it ties back with the capital gain exemption with those two rules on there's the one with the 90% and the 50% for 2 years prior. So yeah, really what Cody's getting at with that too is you don't want to have too many redundant assets in your company 2 years prior to sale and at the time of sale as well, in order to be able to claim or to meet those two tests at least of the lifetime capital gain exemption.
Okay.
And then I was going to circle back to goodwill. There's an important distinction to make on two different types of goodwill, especially when it comes to selling your business. So there's what we refer to as commercial goodwill, and then there's personal goodwill. So commercial goodwill, that the value of that goodwill is actually tied to the business. So a purchaser comes in and all that value and the cash flows that can be generated from that value would transfer to the purchaser. However, quite often there's an element of personal goodwill, meaning some of the goodwill is actually tied to the owner of the business, and then that won't necessarily transfer to a purchaser. And there's different degrees. It's not like all goodwill is personal or it's all commercial. There may be varying degrees of this. Some factors that may point to there potentially being personal goodwill there is if you think about the customers and if they would still come to the business if it was owned by someone else, or if they're coming purely based on their relationship with the owner. You can also think of the nature of the products or services being offered by the business. If it's say a consulting business that's very reliant on the owner's knowledge and expertise, that's probably pointing towards more personal goodwill. You can also think of the number of employees. If it's a company with 3 employees, including the owner, there's higher likelihood that some of the goodwill is personal versus if there's 300 employees. So that's another element to consider.
Janece, you got me really excited. Well, actually, Cody got me excited about this lifetime capital gain exemption, and you're helping me get there. But I was a little concerned when you said if it's personal goodwill, then it won't be part of my assets and I can't sell it. Is there any way to turn some of that personal goodwill into commercial goodwill so I can go use Cody's lifetime capital gain exemption?
Yeah, that's a great question. So there's it's definitely a consideration prior to sale. There's steps you can take in the years leading up, and that's really to start transferring maybe some of the relationships the owner has with clients or suppliers to key employees to spread out the risk of that, and also transferring maybe some of the management duties on to key employees as well. At the time of sale, sometimes in negotiations, the owner could sign a non-compete agreement, which will prevent them from just opening up the same business next door. Or also could, as part of the sale process, the owner could agree to stay on for a certain transition period beyond the time of sale, which would also allow them to help transfer those relationships and any knowledge and expertise.
Thank you.
Yeah, so now moving on to the next slide, we'll touch on the 3 main valuation approaches. So we have asset approach, income approach, and market approach. Starting with the asset approach, this approach is typically used on holding companies or real estate companies. So really companies that don't have any goodwill, and it's like how it sounds. It's value based on the assets. So we would take the market value of your assets less any market value of any liabilities owned by the company. In some cases, say a company owns real estate, eventually they're going to have to sell that real estate, and then there's taxes and disposition costs. So we would take that into consideration, a discounted of those costs into consideration in that valuation as well. Skip over the income approach for a minute and go to market approach. The market approach involves looking at comparable companies or comparable transactions and applying certain metrics from those transactions to the company that you are valuing. So metrics such as like a multiple of revenue or a multiple of EBITDA earnings. The challenge with the market approach is finding these comparable companies and transactions and making sure they are actually comparable to the company you're valuing. Often dealing with smaller private companies, the information out there is not always very comparable. So that is something to watch out there. And that's why market approach is not typically used as a primary valuation method, but it can be used as a bit of a secondary approach or a check to see what's going on in the marketplace. And then third, we have the income approach, which is used for operating companies and when there's goodwill. So this is likely an approach you would see when you're considering valuing your operating business. So on the next slide, we'll look at 2 main considerations for the income approach. Like in the name, it's based on income or cash flows of a company. So there's 2 ways to look at an income approach, and one is to look at your historical earnings. that's called a capitalized cash flow or capitalized earnings approach. But really it's looking at, say, the last 5 years, the cash flows of the company, normalizing it to take out any non-recurring items, and we're trying to get to a maintainable cash flow or earnings number, and really what is the company expecting to earn going forward. The other main approach to contrast that is called a discounted cash flow approach, and that we would use an actual forecast. So looking at, say, the next 5 years and what do we actually think is going to happen. Now, with both of these, when you're trying to look at future cash flows, there is risk to that, and that's where a discount rate comes in. The discount rate is applied to these cash flows to account for this risk. It's also the rate of return. So naturally, if we view the cash flows as having higher risk, you would have a higher rate of return or discount rate on these cash flows to account for that risk. When we're determining our discount rate, there's various layers of risk we would add in there, and that's mostly for valuators to look at, but we look at a risk-free rate. What could you invest your money in risk-free? So a long-term government bond is considered virtually risk-free. Then we look at the risk associated with equity. Investing your money in an equity portfolio is naturally riskier than a long-term government bond, so we add risk for that. We look at the size of the company, so big companies and little companies will have different risk profiles. Looking at the industry, some industries are riskier than others, and then we'll look at factors specific to the company, and that may increase or decrease the overall risk. So we would look at if the company has any competitive advantages or disadvantages, any customer concentration, reliance on vendors, reliance on management or key personnel. So all these factors together will factor into our overall risk and valuation.
So Janece, if I want to, I'm going to ask a question on normalized cash flow in a minute, but with respect to this discount rate, more specifically your term company-specific risks, are there things that an owner could do to change that risk?
Yeah, so depending on the risk, obviously there are lots of different things an owner could do. It's really identifying these risks and taking, thinking about what steps can be taken to help minimize those risks. So even tying it back to what we were talking about earlier with the personal goodwill, if a company has high reliance on the owner, that's going to increase the risk and be reflected in the discount rate. So those same steps of trying to transfer relationships to the employees or some expertise and knowledge to the employees to reduce the overall reliance on the owner would help reduce that risk.
Would another risk be like a customer concentration? If my business had 50% of its sales with one customer, how would that affect, if I change that, how would that affect the company specific risk?
Yeah, so high reliance, like high customer concentration, it is more risky because if you have reliant on one customer for 50% of your sales, the risk, if you lose that company, you risk losing a lot of value in your company. So depending on the situation, you can make sure that relationship with that customer is solid, enter into contracts depending on the nature of the business, or trying to diversify your customer base and reach out to new markets or customers to serve.
Okay. That might be a bit intimidating, but I guess with some thought and some effort, we could broaden our customer base. With respect to the normalization comment that you made a little earlier, what would a normalization, what would you look for? What would a normalization adjustment be?
Yeah, so we're looking for, well, one thing that we look for in normalization is any unusual or non-recurring transactions. So because we're looking at the past, if say there's moving expenses in 1 year, well, you're not expecting to move every year, so we would take those out and say they're not going to recur, and it's not in our future expectations going forward.
Okay, thank you.
Thank you.
All right, so thank you, Janece, for talking to us about the building blocks of value and how value is built and how to manage our risk, and all is not lost. If you have an opportunity to visit with, after you've had so much fun talking to Cody on tax, if you want to reach out to your friendly neighborhood valuator, they can help you understand where your risks might be and give you a chance to decrease those risks and ultimately improve your value over time. Janece, I do have one question for you. It was about how do you account for government subsidies that happened over COVID? Are they an automatic non-recurring item, or what do you think?
Yeah, there's that's a good question. There's two ways to think of them. Well, and either recurring or non-recurring. First glance, that you would think that they're non-recurring because obviously the government subsidies haven't continued. But the nature of the subsidies was to replace revenues. So if we're looking at it on a normalization of prior years, perhaps the revenues decreased and those subsidies are just to reflect what normal revenues would be going forward. So it does depend on the situation. It's not an automatic non-recurring adjustment.
Yes, thank you. I must say that you and I have had to deal with certain clients where that scenario came up, and we do look at it from two perspectives. Is it a replacement or is it just something unusual? So thank you, Janece.